Hello everyone. Return on equity or ROE is one of the most important return ratios in finance. It measures the return earned on shareholders' fund. While most of you are familiar with the return on equity ratio, it is important what truly drives the return on equity ratio. Let's understand the ROE with the DuPont Framework. Here is the formula for the ROE.
That is the first being tax burden multiplied by interest burden multiplied by operating profit margins multiplied by asset turnover ratio and then multiplied by leverage ratio. So let's number all these 5 parameters that are there. This tax burden being the first, interest burden second, operating profit margin being the third, asset turnover ratio fourth, and leverage ratio fifth. Now let's walk through it in order. First being the tax burden. So, as the name suggests, tax burden. That means it shows how much profit is retained after taxes. So, the formula for this is EAT upon EBT. That is earning after taxes divided by earning before taxes. This means it shows how much profit is retained after paying the taxes. So if I further decompose just to understand the tax burden, so I can write it like this also, EBT minus taxes upon EBT. So that will be equal to 1 minus tax upon EBT. So if I see this particular decomposition of tax burden, it gives me an idea that when a firm is paying no taxes, the tax burden ratio will always be equal to 1 and the firm is paying taxes, then the ratio will always be less than 1. Is this okay? Next comes the second parameter, that is interest burden. Again, as the name suggests, it shows how much of operating profit is left after paying the interest. So we take EBT upon EBIT. EBT upon EBIT. If I again decompose the interest burden, then I can write it in this manner, EBIT minus interest upon EBIT. That is equal to 1 minus interest upon EBIT. So again in this case also, as if I am able to see this decomposition, it says if there is no interest, if the firm is paying no interest, this ratio will be equal to 1. And if the firm is paying interest, this ratio will be less than 1. Now coming to the third component, that is OPM, that is operating profit margins. As the name suggests, this ratio tells us how efficiently the core business generates profit from sales. And the formula for this is EBIT upon sales. Higher this ratio, the better it is. That means it is saying that the business is generating more and more profits from the core business. Fourth, that is the asset turnover ratio. Asset turnover ratio indicates how effectively assets are used to generate revenue. That is sales divided by total assets. How efficiently we are using each and every rupee that is employed in the business. Then the fifth component is leverage ratio. Leverage ratio tells us how much of the assets are financed by shareholders versus the other debt that is involved in the business. So the formula to this is assets divided by equity. If I decompose this, so I can write assets are equal to debt plus equity that is total assets are equal to total liabilities in the balance sheet divided by equity. So we can write it as 1 plus debt upon equity. So this ratio, if debt is present in the business, if debt is present in the business, this ratio will always be greater than 1. And if no debt is there, this ratio will be equal to 1. So these are the 5 components for ROE. Now, 2 quick insights. If I see the second and fifth component, that is interest burden and leverage ratio. These two things are combined together, that is 2 multiplied by 5 is known as compound leverage ratio. This is known as compound leverage. That means the total impact of leverage that is there in the ROE. It captures the impact of debt on ROE from both the interest cost and the financial leverage. And if I see the third and fourth parameter, that is 3 into 4, that gives us OPM, that is operating profit margin, into asset turnover ratio, that is equal to ROA, return on assets. It's a key measure of operational efficiency. So if you see OPM and asset turnover ratio, if you multiply both the things, that is equal to EBIT upon sales and sales upon total assets. So sales and sales will get cancelled and we'll be left with EBIT upon total assets. So that is return on assets. So if I further write down the formula for ROE, that is, as the name suggests, ROE, return on equity. So which return? Return which is there for equity, that is EAT upon equity. And as I've already mentioned all the parameters, so we will be starting numerator, EAT is required, EAT upon EBT, that is the tax burden ratio. Then I don't want EBT, so I'm putting it in the numerator, divided by EBIT. This is interest burden upon, I don't want EBIT now, EBIT divided by sales. This is operating profit margins multiplied by asset turnover ratio. I don't want sales now. Sales divided by total assets into total assets divided by equity. So if you see all the 5 parameters, will only be left with EAT in the numerator and equity in the denominator to get the value for ROE.
So seeing here, ROE is not just a number. It is a story of 5 drivers. And through this analysis, we are able to analyze where the value is created and where it is lost. Thank you.